So the Fed just decided to raise interest rates by 75 basis points. But does this have a direct correlation on mortgage rates? Not exactly. But before we get into that, my name is Tiffany. I'm a mortgage loan officer. I can assist in 49 out of 50 states. So if you have any questions or concerns about mortgages and what this means for you, I'm going to leave my contact information in the description box below. So the Fed just decided to raise rates, 75 basis points, but did they directly impact mortgage rates? Not exactly. What the Fed just raised is what's called the prime rate. So the prime rate usually revolves around any open-ended type of credit. So like HELOCs, credit cards, any line of credits. So what happens is they're raising their rates in order to impact how much it costs people to borrow money. But this does not entail mortgages because mortgages are actually based off a completely different criterion. It's actually based off of the 10-year treasury bond and how much is being purchased off of those bonds. So back when COVID happened, the government was buying a lot of 10-year treasury bonds in order to artificially supplement the economy because there was fear that the economy was going to go down since shopping was at an all-time low. As well, to boost the economy through the COVID pandemic when a lot of businesses were shut down or just not operating at full capacity. So the rates were decreased in order to give consumers confidence in the American dollar. They did this for an extended period. So the mortgage rates were low pretty much all of 2020 and 2021. Where we really started to see an uptick was at the beginning of this year, as far as a rapid uptick. So in January, that's when we saw the first increase in mortgage rates. And as a result, we've seen increases upwards of 3 points this entire year. So with that being said, the prime rate actually did not change in January. The prime rate did change in March of 2020, but actually did not get increased until March of this year, so 2022. So what does that mean for you? That means that the Fed does not actually directly correlate with mortgage rate increases. So what happens is whenever the Fed raises rates, they take a look at the economy and what their goals are. So right now we have an inflation problem. Things are way more expensive than they used to be, and as a result, consumer confidence is at an all-time low. So what is the Fed doing to help combat this? The only thing that they really have control over, which is raising rates. So whether you agree that this is an effective change or not, that is the one thing that they have control over. So they're raising rates in hopes that it will combat inflation, make things a little bit more expensive to borrow money, and as a result, hopefully bring down inflation from, the 9-8% that we've seen the past couple of months. But what this is not doing is directly impacting mortgage rates. Mortgage rates, as a result, are watching what the Fed does, and they're saying, hey, the Fed is deciding to increase their rates because inflation's at an all-time high. This means that we need to help the Fed and we need to help the economy, and we can't keep allowing inflation to keep going the way that it's going. So as a result, we will increase our rates as well. Now, is it going to be 75 basis points? There's no telling. I actually have not seen if the rates have adjusted yet or not. But what that does not mean is that today you were approved at let's just say 5.5, and now you're at a 6.25. That's not the way it works. So the interest rate increases on your mortgage rates may end up being 75 basis points, or they may end up being less than that, because it's not, again, directly correlated by what the Fed is doing. It's actually watching what the Fed is doing and the reasons why they're doing it, and as a result, reacting to it. Another good example of this is how rates actually decreased over the last couple of weeks, minimally, but they did slightly decrease a little bit. But the prime rate hadn't changed since June of this year, and it increased from June to July. So it's not a direct correlation. It doesn't mean that your mortgage rate's automatically going up, but what it does mean is that the cost to borrow money is going to go up. So if you have any kind of credit card debt, this does mean that your interest rate is going to get a little bit higher. If you have any kind of lines of credit, again, this means it's going to get higher. And if you are someone who is looking into the mortgage rates, you can anticipate a difference between if you were to get pre-approved last week versus if you were to get pre-approved today or tomorrow. Now, I know a lot of lenders are offering what's called a lock and shop program where you're able to lock in your interest rate while you're pre-approved or before you go into contract. I personally can offer this, but not all lenders can. So it may be worth exploring that option if you are with a lender who cannot offer that option, that you look for a lender who can. Now, there is usually a fee associated with it, so that is something to anticipate, but over the lifetime of the loan, it may make more sense for you to lock in that rate while you're pre-approved versus waiting for your contract to happen, and then rates have adjusted even more since then. So something to explore. With that being said, that is all from me. I hope you guys enjoyed this video. Please make sure to give it a big thumbs up and subscribe if you have not already. If you're looking for more finance, mortgage, real estate content, I'm going to be uploading so much more in the next coming weeks. I hope you guys enjoyed this video, and I hope you have a great day.